Morning, everyone. This is another chapter from the desk of Greg Bodoh. I was recently reading an article from the Chicago Tribune. We don't need to talk about the author or the date, but as many of these articles, which addresses variable annuities, which I'm not recommending, the writer of the article misunderstands a great deal about variable annuities and how they work. Some of his points are valid. Some of his points are just misunderstanding of the key features of variable annuities. Now, that said, I'm not here this morning to criticize the article or the author because I do not endorse the use of variable annuities either. So I thought I'd take this opportunity for anyone who read this to talk about variable annuities and what they really are and what they really are not. One of the things I'd like to point out is that there are many different types of annuities, and so don't in your mind throw the baby out with the bathwater by hearing the word annuity and therefore you have a general opinion of what an annuity is, because there are variable annuities, there are fixed annuities, there are fixed index annuities, there are immediate annuities, there are annuitization annuities. So with all of these different types of annuities, the word annuity is the only common thread in all of these because they're very different. So then for this morning, what is a variable annuity? Well, number one, a variable annuity is offered to you from an insurance company. A variable annuity is a wrapper in the same way that your IRA is a wrapper. You see, you don't invest in an IRA. You invest in the underlying assets contained in the IRA, because your IRA could be a CD, it could be mutual funds, it could be real estate, it could be a number of other things. So the underlying asset class inside the wrapper, that's your real investment. Now, convert that thinking to a variable annuity. A variable annuity is a wrapper. The wrapper provides tax deferral from everything contained inside the wrapper. What's in the wrapper? Well, there's your investments. In a variable annuity, your investment choices are mutual funds. You could invest in these mutual funds outside of the wrapper or inside of the wrapper. The benefit of investing in them inside of the wrapper is that you get the diversification you would have gotten from a portfolio of mutual funds outside the wrapper, except now the earnings are all tax deferred. Tax deferred until such time as you take the money out. Now, unlike an IRA, if you take any money out of your IRA, it's all taxable. A variable annuity that is not an IRA, the only thing that's taxable is money that is earnings on the variable annuity. In other words, your principal coming out is not taxable. The earnings is taxable. You already paid tax on the principal that was invested. Now, on a last in, first out basis. In other words, if you put $100,000 into a variable annuity, or any annuity, and it earned $50,000, the first $50,000 to come out is all taxable, and then the last $100,000 to come out is your principal, so that is not taxable. Again, that's if it's not an IRA. So this sounds kind of neat, doesn't it? Number one, you have a guaranteed death benefit with a variable annuity, meaning if you put the $100,000 in and the value of your account due to the market decline went down to $50,000 and you died, you'd still have a death benefit going to your beneficiaries of $100,000. If your $100,000 appreciated in a rising market to $150,000 and then declined in a declining market, the $150,000 would be locked in as the highest value. That would become the death benefit to your beneficiary. But again, your value while you're living is only the value of the account, the mutual funds, and so on. Now, what's wrong with a variable annuity? Because up until now, it sounds pretty neat. Well, what's wrong with a variable annuity is, number one, you have very high fees, somewhere between 1.5 at a minimum to 3.5. I've even seen 4 of fees and expenses inside the variable annuity. Some of those fees are mortality and expense, usually about 1.5%. And in addition to that, you have the management fee of the mutual funds. And if you invested in the mutual funds outside the variable annuity, you would have those same fees and expenses. Actually, they might be a little higher, but you'd have the same fees and expenses. So you've got a diversified portfolio that's extremely expensive, a great deal more expensive, and in a moderate market, markets where you can expect maybe 5 to 7% growth some years, a 3% expense kind of knocks out the viability of taking the risk of investing in the market at all. By the same token, if you have a down market, in other words, the value of your assets go down in this declining market, you're still going to have that 3%, theoretically, that 3% fee, pushing the value of your asset even further. There's another consideration, whether or not you should invest in a variable annuity using your IRA dollars. Now that's a different subject. I happen to disagree with the popular pundits who say that using IRA dollars and an annuity together is financially redundant, because if the IRA is already tax-deferred growth and the annuity is tax-deferred growth, then why would you invest in a variable annuity? And the point is, or any annuity for that matter, and the point is, you should not use IRA dollars to invest in a variable annuity to get tax deferral. You should invest in some annuity, regardless with your IRA dollars, if the features, advantages, and benefits of that annuity financial product are compatible with what you're trying to accomplish. You see, you don't pay extra for tax deferral. Tax deferral was legislated. If it is an IRA, it is tax deferred. So you don't have an additional expense because it's tax deferred. You have an additional expense because it's some type of annuity, maybe variable, maybe fixed, some type of annuity. Now the question is that expense compatible with what you're trying to accomplish? Now that said, I made myself a couple of notes. Let's see if we covered everything. What is it? I think we spent enough time on that. Why do they seem attractive? I think I defined why they seem attractive, but probably not in most circumstances. They're most attractive in a rising market like we had in the 90s. Nobody cared what the fees and expenses were because they were making 15% a year, so nobody noticed. But in these kind of markets that's a terribly onerous fee to be paying to simply have your money wrapped up in a variable annuity. And why are they not actually a good idea? Because number one, they add to your downside, they inhibit your upside due to the expense, and there simply are other ways to accumulate assets and accumulate growth without the risk of the market and without those expenses. So if you have any further interest in knowing if you have a variable annuity or somebody's proposing one to you, if you'd like to talk about it further with somebody that's totally objective, I'd be happy to take your call. 540-347-2125, and anybody on the staff can schedule a simple telephone appointment for you if I happen to be busy at that time. So thanks for listening again, and happy trails to you, and if you're Russian, das Vidanya.